is not just about returns, but stability, stewardship, and impact. Can you speak to that mindset?
Well, I think when we have an abundant mindset, things just flow to you. So, I mean, when you want to give back and when you think beyond yourself, I could have kept doing this journey all by myself, but I was like, if I bring others in, they're going to make more money. A lot of people don't know how to vet a deal or don't have the time to do that. If I'm already doing that, why not share that with others? Then that comes back to me too, because now I'm making more on my money.
Hello everyone and welcome back to The Path of Progress. I'm your host Alex Kononov and today's guest is Maria Zondervan, the CEO of Blue Vikings Capital and a powerhouse in both real estate and impact-driven investing. She has over 2 decades of experience managing multi-million-dollar portfolio and is currently GP or fund manager across over 2,000 multifamily units. But what truly sets Maria apart is her mission-driven approach. She's not just investing for returns, she's building a legacy. And today we'll unpack both sides of that journey. Maria, welcome to the show.
Thank you so much for having me, Alex.
It's a pleasure having you, honestly. I really was looking forward to this for a long time. But Maria, let's rewind a little bit. What first got you into real estate back in the 90s? While you were still a student, right?
Yeah, I was a student at the University of Florida and in Gainesville, Florida. And I was watching an infomercial late at night while studying, and I just saw this program that was advertised as Carlton Sheets. For those of your listeners who might be as old as me might remember him. But he had a real estate course on how to buy real estate with no money down. And it came on cassette tapes, just to tell you how freaking old I am. So that was back in 1996. And sure enough, I took the course. I got hooked. I'm like, oh my gosh, I think I can do this. So went hunting for a property and found a seller who was willing to either rent or sell the property, which told me he was very flexible and didn't need the cash out. So we structured a lease option. And that's how I got into the first property, even though I had no credit and no money to put down on a house. And so I was like, I can't believe I just bought a house. And so that kind of got me hooked right there and then. So it wasn't the path. It wasn't what I was studying at UF. I was studying to be a wildlife ecologist. So I ended up working as a wildlife biologist for 26 years. But I kept doing real estate on the side because I was like, wow, anyone can do this. This is great.
It's fun. So for our listeners who are new to real estate, what is lease option and how do you structure a deal?
Yeah, so you're leasing the property like you're renting it, but you have the option to buy. And you can structure it in a number of different ways, but we did it so that part of our rent gets credited towards that down payment. So if you don't have a down payment, it can be a great way to build it up over time. And then it also gave me time to work on my credit so that I could refinance with the bank eventually when that lease option wears out. And those options could be a year, they could be 5 years, they could be 10 years. You know, you structure it whatever's going to work for you. But we structured it long enough that I could build that credit and refinance it with the bank when I had sufficient down payment built up. So never had to come out with a big lump sum.
That's what real estate is all about. Creating a win-win situation between the buyer and the seller. And this, in your case, he helped you to get you more time to build a credit. And at the same time, he already has someone in property who wants to live, and he has this home ownership state of mind. And now he doesn't have this maintenance calls and all these issues because you as the owner technically at some time in the future, but you already treating this as your own home.
Exactly. And we house hacked at the same time, which no one was using that term back then because nobody had it. But it was a 4-bedroom house and it was just me and my boyfriend at the time, who became my husband. So we rented out the other half of the house because the kitchen was kind of in the center. So it worked out perfect for us. So what we rented that half for was extra money that we could save up for that down payment and just for extra money and for making that mortgage payment. So even though we couldn't afford the house, we couldn't afford the payments, and we had no down payment, we were able to get into that first property.
Love it. So you've been creative in the creative deal. This is amazing. And tell me, did you learn about this in this course?
We learned about the lease options in the course, not about the house hacking. That was just, we got extra bedrooms, we don't need them.
Progression.
Yeah, exactly.
Love it. And at that time, your husband now, was he also into real estate or it was just your push?
Yeah, no, it was me, but he caught the bug shortly thereafter. He was actually a student at the University of Georgia, and he was studying economics. So he did definitely have the finance mentality and eventually became a mortgage broker and got involved with lending and all that kind of stuff, which has served us well today. When we get to that part of the conversation where we are today, then he feeds into that part.
I love it. You started investing, you understand it makes sense, and he understood it makes sense financially, and now you just guys got into it. Okay, so what after that? You got your first deal, you lived house hacked. What was your next move?
Well, being early career professionals, we moved a lot. So every time we moved for a job, we would buy a new property in that place and we would keep the old one and we would rent it out, right? So that became the strategy for a long time. So it kind of became accidental long-term buy and hold stuff. And then after we had seen how that was working out, then we started doing some flips. I hated those. I was terrible at them. They always took longer than anticipated and cost more. But, and I just didn't have the eye. You know, some people just have that creative vision, and I stunk at that. But it was fun to try it out, and it did let us learn the business, learn the numbers. So then later in life, like now, we finance other people who do flips, and we can underwrite those because we've been there, we've done that, and Don, like I said, did the mortgage brokerage, so he understood that section. But yeah, so we tried a little bit of everything, and then we sold on lease options as well because it worked out so well for us. And you brought up the fact that tenants are going to have more of an ownership mentality. They're not going to tear up your place if they're planning on buying it. So with some, we don't ask for some money down, but not as much as they would need necessarily with a bank, but enough to get them in there. And fun story, this just happened, Alex, just last week. Someone connected me with somebody named Kip, and I said, wow, Kip, that's an unusual name. I've only ever known one Kip before, and he's the guy who bought my first house on a lease option. And sure enough, it was that guy.
Wow.
Yes. So we connected, you know, over 20 years later on another real estate deal. So it's amazing how these things go full circle sometimes.
Interesting. You got into your first deal through lease option by being a buyer, and also it's the same story with him. You inspired, you kind of passed the torch, and hey, and you now connected. Awesome. Love those stories.
Exactly. Yeah, that was his first step into real estate too, and he became a landlord after that and bought properties and has done very well. So it was really fun to hear his story now.
Amazing. Amazing. Okay, so you got into lease option, you moved a lot, you sold some houses, you kept some houses, you did a lot of underwriting, some flipping, you understand the business. So what are you doing after that?
Yeah, so then right in the 2008 era, so right before the crash, we sold off a large part of the portfolio to buy another business. We bought into the Massage Envy franchise. You may have heard of Massage Envy. They're pretty big now. But at the time, they were almost, you know, they're brand new. And they didn't even exist in Florida yet, but we sold some of the houses to have the down payments and to get the SBA loans to open those or open our first location in downtown Orlando. And so I'd like to say we're just brilliant and timed the market really well because it was at the height of the market. People were fighting to buy the houses, and then they crashed right after that. So I want to say I was just like a genius, but it was really just circumstantial. We just need the money out to go do this other thing. So it worked out really well. We ended up buying that first Massage Envy, closing that during a time when all the banks were shutting down and disappearing. I mean, that in itself could be a whole podcast. We won't get into that, but it almost didn't happen. So we almost ended up selling the real estate and then not getting the businesses. But last minute it worked out, and I do mean last minute. So we ended up getting those up, and then we're like, oh no. We just opened a brand new business during economic recession, plunge of everything. We're like, what did we just do? But it ended up working out great because during recessions, people don't travel and take vacations and do all that kind of stuff. So instead, they treat themselves at home. And ours was sort of a membership-based, low-cost way to get a massage and pamper yourself. So it actually took off and did phenomenally well. And that led to the next problem of now we have a tax problem, right? So businesses that cash flow well are a blessing, but they come with a very hefty tax bill. But we eventually figured out that the way to solve that problem is going back to real estate. So we would take the profits from the Massage Envy clinics every quarter, would siphon some off, and put it back into real estate so we could get the depreciation to write off the business income. So there's a nice synergy.
Very nice synergy. You diversified from real estate right in the right time. You made your cash flow in business, and you're going back to real estate because you still have passion for it, and you need an exit for your capital gains. So it's a win-win. So while going to real estate, by buying single family properties, it's probably not the best route to offset your taxes, right? So what asset class did you choose, and how did you learn about it?
I went into multifamily, and honestly, I don't recall where I first heard about it, but I started attending masterminds that were all focused on it once I had learned about it, because it just blew my mind that regular people can own apartment complexes. Like, it didn't even dawn on me. The idea was always just buy a ton of single family homes, but it's a lot of work to do that. It's a management nightmare. It's a lot to keep up with, taxes, insurance, all that kind of stuff on every single asset. They can get torn up. There's just so many reasons why it's very hard to scale. And so when I learned that even average people can go buy apartment complexes without millions and millions of dollars in the bank, I was hooked. So I was doing it. Timing, again, is everything. So this happened in 2020. And there's another little event that happened there. I seem to make big moves right before recessions, and in this case, a big international pandemic. So we were set to close on our first apartment complex. It was a 12 unit in March of 2020. The banks were once again closing their doors and couldn't talk to anybody, couldn't be within arm's reach. So it was absolute chaos. But thanks to a small local bank, we were able to get that first loan and secure that. And at the time, they were financing 85%. And we also used, 1031 exchange and all that kind of stuff that we can talk to help out with the down payment to get into that. But yeah, so 2020 is when we rolled into that, because you're right. You need bigger properties with more depreciation and preferably the ability to do cost segregation study if you really want to be able to write off those taxes. And it also meant giving up my 26-year career as a wildlife biologist, because I had to become a real estate professional to take maximum advantage of the tax options. And once I did the math there, I actually found out I'd been working for free for 3 years at my previous job, because we saved so much in taxes it replaced my entire income.
Love it. It's very interesting. I actually bought my 7 unit in January 2020, and I closed on another duplex in March 2020. So I lived through this time perfectly. But tell me, what city did you close on this multifamily?
It was in Dade City, so it's a very small little town in Florida. And so it was a local bank that was also in that town, so that's why they financed it. They currently had the mortgage on it, so they wanted to retain that business, so that kind of gave us an in. They knew it was already performing well, so it made it easy to close. By then, obviously, we had built up our credit too, so that helped as well, because at that size property, it was still a recourse loan. Now we try to do all non-recourse loan, but at that time, we still had to sign a personal guarantee for that loan.
Is it when you started Blue Vikings Capital?
Yes, yeah, right around that time. We had actually started a little sooner than that, but yeah, that's kind of where it launched. And then we bought another apartment complex shortly thereafter, and then went into syndications. So I know a lot of people go straight into syndications, but I did not want to take a chance with other people's money until I had learned all the do's and don'ts on my own, because you learn a lot managing small apartment complexes, even medium-sized apartment complexes. You just learn a ton, and it really helps you vet operators and partners and figure it all out before you're responsible for somebody else's money, which is a huge responsibility.
Was it a value add property, or was it stabilized?
Both of the apartments that we bought were stabilized, but they had room to improve. So yes, there was value add, but they were over, I think one was 85% occupied and the other 95%. But also, as you'll recall, in that time, rents were going up kind of automatic on their own as well. But that also led to our taxes and insurance going up too. So we did do a lot of improvements to those places to bring up the rents even more, to kind of keep pace with that.
So you had tenants, and on the go when they move out, you just fix the pump and increase the rents to the market, and you increase the value.
Exactly.
So tell me a little bit about your company, Blue Vikings Capital. What's the story behind the name? Is it connecting somehow while you were studying in Sweden?
Absolutely, yes. So I am indeed a Viking, born and raised. I was born and raised in Sweden, and I lived there till I was 9, and then moved over here with my parents. And then we actually returned to Sweden every summer throughout growing up. And so I have a brother who still lives in Sweden. He moved back there years later, but during the summers, my parents had no idea what to do with kids when they're out of school, so they shipped us back to Sweden to be with our grandparents over the summers. So we kept that Swedish tie. And my brother ended up living in a Viking village, and all that Viking stuff kind of hung in there. So when I had to pick a company name, it seemed like that was the way to go. And we went with the blue and gold because that's the Swedish flag colors. But I'm very Americanized at this point, but it's still fun to have those ties, right? To have a foot in two worlds, so to speak.
No, it has some story. Listen, this is some heritage. I love it. This is very interesting to hear. So, after you're done with your first property, what did you do after? Did you go after another multifamily, or you went to syndication to go to bigger properties?
Yeah, we went to syndications to go to bigger properties. So the first step into that was to invest with somebody else as a LP or limited partner. So, this is where you just put in the money towards that down payment. Obviously, the bank is the biggest partner in those deals. And then you've got all your limited partners that come in and bring funds, and they become partial owners in that property and share in the cash flow and the exit funds when the property finally resells. So we did that first just to see what that whole process looks like. We were introduced to that at a local meetup. Found somebody locally that was doing that, got involved with them, and again through the masterminds. I can't stress enough the importance of getting in the rooms with people who are doing bigger things than you, so you have someone to learn from. You don't feel uncomfortable being the small fish in that room, because that's you're in the right room if that's the case, right? So always get around those people so you can learn from them. So did that first just to see the process. And then my goal after that was to launch my own syndication and buy my own property. But at that point, real estate market in Florida had gone crazy and the prices were insane. And it was really hard to find anything that cash flowed here. So I was out of real estate, but I had been doing all the stuff to prepare for it. I've been lining up investors, nurturing, doing all that kind of stuff. Then I'm at a mastermind where there's a gentleman there who had the opposite problem. He had lots of deal flow, but he didn't have any investors lined up. So I said, well, maybe we can do something here. So I ended up co-GPing with him on a property in the Carolinas. And so that was my first co-GP syndication. Primarily did investor relations for that, bringing in investors, but also a lot of the due diligence, market research, and all of that. He had already found the deal, and so he did the legal structuring, and it ended up being a good partnership.
You can't just be capital raiser in syndications. You have to know how to underwrite market and the deal, because in the end of the day, you are the person who is responsible with your investors. You have fiduciary responsibility to know everything about the deal, pros and cons, and vet it before even bringing it to your people. I love it. And just want to add a little point to masterminds and your networking groups. If you are the smartest and the best person in the room, you're in the wrong room. So find the rooms that will help you to grow and mastermind and networking group that will get you to another level. But Maria, you jumped right from, hey, I got my multifamily, I have first LP deal, and then I already raising capital for GP. It takes some time and actually a lot of work. You were super modest about it. You're like, yeah, I just got some relationship going, but I know it's building the trust. It takes a lot of time and dedication. Can you unwind a little bit? How did you actually build trust with your investors? I mean, putting their own capital in the deal, in the new deal, especially you and new GP here, it takes a lot of commitment and.
Yeah. Well, you start with the people you already know because you already have some trust capital there, right? But there is also going to be a shift there because a lot of the people I knew, they knew me as a wildlife biologist. And they're like, what does a wildlife biologist know about real estate? So this is where I learned that I'd been doing something wrong for years. I'd been doing real estate on the side the entire time and doing very well because I knew, although my passion was all about saving endangered species, that's what I was doing. I knew from the get-go that you're never going to make good money as a wildlife biologist working for the state. So I knew I had to do that on the side, but I was very modest about it and I kept it to myself. I was doing the secret agent thing. And you learn very quickly that in the real estate world, you can't be a secret agent. You have to tell everybody what you're doing and tell them why you're doing it and tell them how well it's going and share the pitfalls when it's not going well, because although we're jumping through the years here really quickly, obviously there were some pitfalls in there. There were some things that didn't go well. There were tenant issues. There are all sorts of hurdles, right? But you learn from every one of those. And but I had been doing it as secret agent. So when it came time to capital raise and I start talking to these people about, maybe they'd want to invest in this property, they're like, Maria, what do you know about real estate? I'm like, oh, well, I've been doing this for all these years. Did I never mention that? And it turns out I hadn't. So that was a big lesson, is don't be a secret agent, because they knew me and trusted me from just knowing me personally, but they didn't know and trust my real estate abilities because they had no idea I'd been doing that. So I started having to share about that more. And then only knew me from that space and building new relationships. But yeah, it starts with the people that already know you. But like my own father, who obviously trusted me and had plenty of money to invest, he didn't invest with me for years and years and years. I think it was like, it may have been, 2024 or 23 or 24. End of 23 or early 24 was the first time he invested with me. Because even in his eyes, I was still that wildlife biologist. And he knew I had owned real estate, but he's like, multifamily is a different beast. And he's right. But when it comes to due diligence and market research, those things are the same. They're just at a bigger scale. And so that's kind of where it grew. But then you have to go find new investors, because the people they only have so much money to work with, right? Eventually the dry powder runs out. So you got to keep asking for referrals and attending new events, and you're going to have a bigger obstacle or harder to get to the trust factor there. So it helps if you can get on stages, get on podcasts, write a book, do things to show your knowledge and let people know that you're the real deal and you really do know what you're doing.
No, I totally agree. But tell me, when was the switch happened? After your first multifamily deal, or it took a while after that until you attended some networking events and you got this idea and then you're like, I have to do it?
Yeah, I mean, like I said, it was accidental. I had planned on always being the deal finder. That's where I thought my strength laid. But because I was a very good underwriter, I'm one of those nerds that actually really enjoys spreadsheets, and maybe that's from the science background, but science and math. Yeah, I was talking to another nerd right here. But that science and math background is really strong. So, right, I can make a spreadsheet thing. I'm good at doing that stuff. I like doing research. I like digging into the finer details. And it turns out there aren't a lot of people that like to do that. They like the flashy, funny, the shiny objects and the pretty pictures of the properties and all that kind of stuff. And I was going beyond that. So it turns out that was a needed skill set. And so that was my way into a lot of teams. So I helped out on teams doing hotel to apartment conversions, learned a ton there about, codes in various counties and what it takes to get something rezoned, and so many issues when you're doing conversions. But again, I'm just a sponge for absorbing that knowledge. But I just found that between the underwriting skill and the fact that people tend to trust me fairly quickly, I guess, because I just always shoot them straight, led to a good fit for raising capital. And I always put my own money in there, which I think people realize. I'm like, okay. And I'm not putting out a deal every single week, because I'm only doing it every quarter as I pull money out of the massage envies, and we have more clinics now. There's more money to pull out, but we, that's once a quarter. So I'm really just trying to do 4 deals a year for my own money. And then my money makes more money when we put it together with a lot of people into a fund, because then we get higher economics for everybody in that fund. And so it was really just a selfish move on my part to get my capital working harder that led to all of it, but it's turned out really well for everybody.
I love it. And just to unwind a little bit more, you have skin in the game, and every single property that you at GP, you put in your own money, and it gives you some certainty for your potential investors. Hey, I'm putting my own capital into the deal. I believe in it with my money. So if you want it, go ahead and we can share the proceeds together. I love it. It's a very strong message.
Yeah, investing alongside each other more so than, hey, I think you should go invest in this property. No, it's, I'm investing in this property. Would you like to come along? I've already done a lot of the due diligence, but here it is. Look at it, make your own decisions. Never high pressure sales techniques. I don't want anyone to ever feel like I got them into a deal. Like I'm offering them an opportunity and they can choose whether it's a good fit for them. So that's kind of where it is for me. And I don't push it. I'm not out there to try to raise, $10 million per deal or something crazy. I put it out there. Whatever money comes in, and some deals people really like, others not so hot about it, and that's fine because I don't have a quota and I'm not trying to close the deal, right? It's not my deal, and that means there's a whole lot less pressure on me, which means I don't have to pressure anybody else. I'm not biased over this property or that property because, again, not my deals that I'm trying to get closed, right? So I'll have, now that I've been doing this a while, my inbox is full of deals every day, right? There's all these sponsors that want me to raise money for their deal because they've got the perfect deal. Well, I'm not biased, so I'm going to look at all of them and I'm just going to pick the best, which is really nice because I get to select from all the best operators out there and work with some of the best in the business. And that's a great experience for me, and I feel like I'm bringing something of real value to my investors because I'm no longer just playing with the newbies, right? I'm getting into those big deals. But yeah, there's no pressure on me to get something closed, so I don't have.
And I think investors can feel the pressure. If you're under pressure, we have to raise $1 million, $5 million. You get in. They're like, whoa. I feel like I need to sit out on this one. Let's see how it goes. And I just wanted to add, I have a good idea. You should have this commercial, Maria, like the ship, Viking ship, and Blue Vikings, and everyone's rowing, hop in and go into another deal. That'd be awesome.
That's funny. Gonna have
Accredited
to figure out how to do that. Yeah, that could be the name. Although we do work with non-accredited investors as well, so we do a little bit of both.
No, but if you advertise it in a commercial, I feel like it should be.
Oh, you're right. If it's a commercial, yes, of course. That's funny.
Okay, so now you mentioned something else from just the capital raising. You mentioned fund. So at what point you decided to change the structure of just the capital raising to become a real fund? Yeah.
Well, you mentioned if you are a co-GP, you have to do more than just capital raise for the deal. That means taking on more and more responsibilities, and I can only layer so many of that because I already, I've got a full-time job. We have an income fund, which we can discuss later, but that's my full-time job, is placing money with good borrowers. And so the capital raising is kind of it's a smaller thing, but it can't be all-encompassing. And if you're really going to be a true co-GP, if you're going to be a general partner in that deal, you need to have an active role in there all the time. And I can do that on a few deals, but I can't do that on every deal. So if I'm wanting to do 4 a year, after 20 years, like think about how many properties you're involved in, or even 5 years. And so that was going to be too much. And there's a little more safety in coming in on the LP side, limited partners, from limited liability also in that perspective. But more than anything, it was about getting my money to work harder. So when you start working with some of these larger operators that are trying to close 200 to 500 unit properties, right? You're talking a big capital stack there. And so there's usually investment tiers. So let's say the minimum investment on that deal is $50,000. Okay, so maybe the $50,000 level, you're getting let's say a 70-30 split and a 7% preferred returns, and your overall returns are going to be maybe 15-16%. But if you can write a $500,000 check, they're going to give you better economics. So maybe they bump you up to 75%. Maybe you get 1% higher pref or whatever. And then if you're at $1 million, you get an even bigger piece of the pie, right? So a lot of these larger sponsors, they'll have these tiers. And I always wanted to get to that top tier. I always wanted the returns of that top tier, but I couldn't write that big a check. But if I form a fund and we all invest together and the fund cuts a check of that size, we can get those higher tiers, and then we can split that within the fund regardless of whether you're investing at $50,000 or, $250,000, we can get those higher economics. So, you might not get the full economics of the top tier because there are some costs to setting up a fund and you have to absorb those costs. But it's going to be better than, even the second tier in there. So you're going to get somewhere in between the two. And if it's large enough, if you raise enough money, you could negotiate a side letter to get even greater returns. I've negotiated as much as 100% of the equity backside. So we've gotten some really great returns for our investors.
I love it. And how big is your fund right now in terms of funds and deals?
Yeah, so it's not a continuously growing fund. We do an SPV fund for every deal. So it's an individual fund for every deal. And so there'll be a minimum of $1 million because that's usually where you get those higher tiers. But we could go as high as 3 million in there. But they're SPV funds, which stands for single purpose vehicle funds. So they're formed just for the purpose of investing in that one property. So we do have to absorb the cost of setting up a new fund for each entity. Right. But it means that people know exactly what they're investing in, unlike a blind pool fund where hey, come invest in this fund. I promise I will find good deals for this fund to invest in. It's not that. You'll know upfront exactly what you're investing in. So it's similar to investing straight into any deal where you get to choose, but it's going to get higher economics.
Yes, and since you under your umbrella, under your new fund umbrella, it will be like one unit invested in this deal.
Exactly.
Rather than 50. And it's better also for general partners in the deal, who is a co-sponsor, because now they have to deal with you, and you will be managing your own investors from that fund. So in terms of time management, like you mentioned, it's might give me much more organized and cleaner process.
Yeah, and that's why they're willing to give you better economics, is for that purpose as well, right? It's not just the big check, but the less headache. It means something. And it's less cost to them then too. Yeah.
So it's more like they setting up JV basically. You investors there because it's going to be just one finance partner. In this case, your fund, and depends on the deal, of course. And it's going to be simpler to manage it. Yeah, makes sense. So how many deals right now you have and how many funds you have going?
I should have looked that up before we talked. So I can tell you I'm in 7 different states.
Rough ballpark.
Yeah, and over 2,000 units. We're getting ready to close one here. Well, by the time this podcast is out, it will have closed because it's in 6 days. We'll be closing another 234 units. So I think probably got 4 or 5 funds, and then a lot of co-GPs before I had the light bulb go off that the funds was a better way to do this. And then, of course, we have the income fund, which we launched back in November of 2024. So that's more of a cash flow play than the syndication type of plays.
And what is the structure there? You buy also multifamily assets for the cash flow or something else?
No, it's a debt fund that lends money to fix and flippers, since we used to do that. So we understand that. With Don, my husband's background as a mortgage broker, he understood the lending aspect. So we could put those together, because a lot of my investors, I'd come to them with the next deal and they're like, Maria, we're tapped out when it comes to the bucket of long-term holds. But we got this other money that's sitting in bank accounts earning 2 to 3%. What can you do for that part? We want that, but we also want it to be passive. So that's why we decided to create the Blue Vikings Income Fund. And so that basically lends money to these flippers, and then I share those profits with the people in that fund. But it's set returns where they know exactly what they're going to get. So they invest at a certain level, they're going to get 7%, 8%, 9%, 10%, or whatever, based on how much they invest. And we pay every single month. And they can leave it in there for compounded interest if they want, so they can earn even greater returns. But it stays liquid. So after 6 months, they can pull money out at any time. They can add money at any time. And if their account grows, it bumps them to the next tier. The entire balance gets that next tier returns. So it's become a place where some people are putting the money that they know they're going to need for taxes at the end of the year, let it grow in the meanwhile, or for their business accounts, right? The businesses have times when they're creating a lot of cash flow and times where it's really kind of, we need to pull some of the reserves. So it holds business reserves, and just for individual people who had money in money markets or CDs that just aren't paying very well. So we can get them a whole lot more on their money but it came from investors requesting it.
And maybe they're not that comfortable with long-term investing, but they want to have diversified portfolio and it's short to learn. It makes sense. Okay. Let me ask this question. I know you have a lot of funds and you're raising new funds for new properties. How do you find those investors? Besides your network events and coaching, do they find you nowadays? Because I know high income professionals and it's hard for them sometimes to shift into passive investing, right? So how do you help them to overcome those questions?
Lots of education. Lots of education. So I do produce content for social media, which helps. I participate in a lot of conferences and summits. We've got the CREA summit coming up September 13th, I think it is. And that's the Commercial Real Estate Investor Association. And so that's for business owners who want to come and learn what passive investing is all about. So it's just a free event that people can come to and learn about this kind of stuff. So it all comes to educating. And because we're business owners, we understand the cycles they're going through. We understand their tax situations. So we help figure out how to reduce taxes, how to make passive income. So if you want to get out of that business, a lot of them are just stressed out professionals too, like doctors and dentists and things who are just like, they make good money, but they're oftentimes miserable and they're really tied to their business. So it's like, yeah, if you'd like to scale back or retire early, you need to build that passive income. And here's the strategy for doing that. You're not forced to just go to the stock market. A lot of them don't know there's another choice. So it comes down to education and just attending a ton of events and just talking to people and not being the secret agent, right? Tell everybody what you're doing.
Get out there and talk about it. And those events, are you talking about real estate specific events, or you attending some other events that you can find the potential investors?
Yeah, I mean, any event I attend, I'm going to talk about it for sure if they give me the microphone, right? Or just talk to individuals as I meet them. But yes, I do go to a lot of real estate events. I do that not just to meet investors. I do that because I want to meet sponsors. All the sponsors out there, I want to get to know the very best of the best. And they're going to be at some of the big conferences. And so I tend to attend those. You know, I'll meet them over Zoom. I'll hear about them. I'll see their webinars and that kind of stuff. But I want to get person to person with them. I want to go out to lunch or dinner, sit down and really discuss their business models, their long-term plans, all that kind of stuff, and get to know them on a more personal level. So that's another reason I go to those events. So, and that helps you later with the investors too, because they're like, how do you know this person? And you can say, oh, okay, well, we met up in Salt Lake City and then I saw him again in Houston and then, you know, came to Orlando, did a conference there and that kind of stuff. So that helps a lot too.
It's building rapport, and now you comfortably face to face, you shake hands, it's a personal connection instead of just a visual intro video call. And your investors feel more comfortable because, okay, have you met this sponsor? And you're like, yeah, we actually met at this conference, we talked about it, we vetted this person, and it sounds like it's a good fit for us at this structure.
Yeah. And I'd say over 85% of my investors are people I've met face to face. There are very few that will invest with you. I mean, we're talking pretty big checks that someone's going to write, right? The minimum investment for most of ours are $25,000 or $50,000, and then it goes up from there. People don't write checks like that to strangers. And even if you've met over Zoom or you've seen them on social media and you followed them and all this, you don't know that person until you've met them in person. You can hide a lot. Like, you don't know if I'm even wearing pants on this podcast, right? Like, you just don't know.
Totally.
How many videos have we seen of that, right? And so until you meet someone in person, it's really hard to judge how they are. And anyone can pull the wool over your eyes for a 15-minute something online or a YouTube video or something. But how are they all day long, every day? You need to meet those people in person. And so a lot of the events I go to, they're multi-day events where you get to see how people react, not just when they're on stage or as an attendee or that 5-minute conversation, but you can keep an eye on them for 3 days and see how they treat the servers when you're having lunch. You know, just see how they treat ordinary people and see who you want to do business with. And I turn down investors. I turn down a lot of sponsors because I have a certain category of people that I want to do business with and others that I don't.
I think it's an important message here. real connection. And especially during the COVID, we lost it a little bit. But now I feel like there is more importance nowadays, and people getting back to it, going outside and meeting people and getting personal connections, conference meetings. And this is have another meaning nowadays. Since everything is so digitized, meeting someone in person is goes a long way.
Yeah,
Love it.
absolutely.
Okay, Maria, I would like to switch gears and talk about something different, something that truly stands out about you, Valhalla Villas. Can you share the origin of that nonprofit?
Yeah, so it's a nonprofit to provide housing for autistic adults, and that's because my son, my oldest son, Carl, is on the autism spectrum. And that was kind of the wake up call that made me kind of jump full time, feet first, into real estate. As he was growing up, as a parent of a special needs child, anybody out there who's in that boat knows that just getting through the day to day is so hard, just getting through school, that you don't think all too much about the future. Then all of a sudden it's there. It's like a slap in the face. So when my son graduated high school, told he would never do, and certainly not with a regular diploma, but he did both because we refused to accept otherwise. So you got to be your kid's advocate and believe in them, and then they will believe in themselves. And he did. He did wonderful. But then adulthood's here, and you realize there's no support once they turn 18. Like there's support for them as kids, and then there's nothing. And it's really hard for them to find jobs because they have really poor social skills, generally speaking. Even if they are on the higher functioning end, they might have all the abilities in the world, but no one will take a chance on it because they're different. And it really stinks because they have a lot of special qualities that make them immensely good, loyal employees. And anyway, I'll get off my soapbox. The point is, I really started to worry about his future. I'm like, I need to build legacy wealth. I need to build something that's going to last forever to take care of him when I'm gone. And I don't know when that's going to be. So it needs to happen fast. So that was one of the reasons we scaled into multifamily. And then I started talking to other parents, and they all had that same worry. Like, what happens when we're not here anymore? Who's going to look after my child? Who's going to make sure they're safe, that they have food, that they have a job, that they have transportation? Because, about 50% or so, even of the high functioning, don't drive. Might be more than that. And this is a huge thing now. Like 1 in every 36 kids born in the US is being diagnosed with autism. It's like mind-blowing to think about. And no one's really talking about it. So there's a huge need for this. So that's what we're going to do. Communities where it has all the things in place for them to live independent of their parents, but still be in a safe place where those needs are met.
First of all, I know it's deeply personal, so thank you for sharing. It's important to understand where you're coming from, to what you're doing for the community and for people with disadvantages. Can you unwind a little bit? And you mentioned that you building, so your fund is specifically building communities for autistic adults.
Yeah. So we haven't launched the whole thing yet. Let's just put that out there.
Okay.
So we built the model, we've got the board, the nonprofit is up and going, but we launched right when the Florida market went crazy, and it didn't make sense to try to buy anything at those high inflated prices. Now they're coming back down. Now it's a buyer's opportunities. Now we're looking hard. So we're basically going to take the skills we already have in syndicating properties and raising money, but we're going to alter the model a little bit. So we're going to buy large apartment complexes and convert 25% of that over to autistic housing for autistic individuals. Then we'll bring in the nonprofit to provide the services to those people, because they don't want to live in a special needs community necessarily. They want to feel like, because they are just ordinary people, right? So they want to just live in an apartment complex like everybody else, but it needs to be a safe one. It needs to be in a good neighborhood. It needs to be walking distance to grocery stores and employers, so that we don't have those issues. And there needs to be some safeguards and social services in place on site that's going to look out for their well-being, because they're tend to be very gullible, very trusting, and people take advantage of that. And if you don't force them to get out every now and then, they will just sit in their apartment all the time and just get absorbed into computer games or whatever. So you gotta get them out there and force them to socialize a little bit and make some friends so that life has more of a meaning. And that's what it's all about. So we're really excited. I just looked at a property this week that could really fit the box. I think they're gonna have to come down on the price. They're still thinking it's 2 years ago on this price, but I think they're gonna budge. So we're getting excited to launch that. But it'll be launched like a syndication. So special needs parents and anybody who wants a long-term investment. So most syndications hold to 3 to 7 years. This would be a forever hold. Where we get to a certain point, we refinance, so you get your capital back, but you have a forever ownership in this property. So you get cash flow for life. And if you are a special needs parent, that cash flow could potentially pay for your child to live there or in some other place that offers something similar. There are other communities that have been built like this. We're modeling after them, except they didn't do it in a syndication model. So it's forever paying rent out of pocket for that. But money you might otherwise spend on a down payment for a house if you were helping your child buy a place that maybe they can or can't keep up on their own, you could instead put into an investment like this that would ultimately pay for them to live there.
Basically, what they're trying to do is just a similar assisted living facility, but for autistic kids. But yours is getting a twist, and now you're creating a sustainable model for people to help their kids to continue living in a good quality conditions that will be overseen with special services and government. And let me ask you this. Is there any government programs that help with funding for autistic kids, or there's nothing like
that? There are. They are full of red tape, and that was one of the things that stalled us out initially, because that's what we were going to do. We were going to go for the grant funding to build these things. But here's the problem with government. And I worked in government for 26 years, so I'm very familiar with all the red tape. But they don't understand autism the way a parent of an autistic child understands autism. They just hear special needs. And so they want all special needs communities to be the same and follow the same blueprint. So we brought, our plans to them, and they tore them up basically. He said, no, you got to have wider halls for wheelchairs. You got to have railings everywhere. You have to have braille for the blind. You have to have they wanted to incorporate all things special needs into this community. I said, there's nothing wrong with their legs or their eyesight. They're autistic. These aren't needs that they have, but to get their grant funding, we had to check the box for every special needs category there was, which ultimately ended up adding $30,000 to $40,000 per unit in cost to build the complex. And we're trying to provide something that's affordable to the average person. And it's not when you tack all that on. So even though they're bringing some money to the table, overall your costs were still accelerated, and then you had forever all these government regulations that were going to tell us what's right for these individuals. Well, no one knows that better than the people who live it day to day. So I really resented them coming in and telling me what my son needed. I know what my son needs, right? And so we decided to just privatize it. Forget the government grants. We're going to do this on our own so we can do it our way. Help them get employed, all the things that they need.
And who knows better what they need, like the parents of autistic kid. And you mentioned very important thing. Even if you put a healthy person, telling him something wrong with you, there is going to be something wrong with this healthy person, regardless how good you are and how bad. So it's important to surround them and us, good mentality, with the right thinking, straightforward every day.
Exactly.
So are you raising capital for this fund? What is the status of this nonprofit right now? I know you have some plans you just mentioned, but what's beyond it? Do you have timeline?
Yeah, so I mean, the timeline is to try to find something over the next year to lock up and do our first syndication and do the first model of this here in Florida. Once we have a proven model, I would love to take it across the entire United States because, like I said, this is a huge need. I've got people in Texas begging me to go start one there, all over the place. I speak to these parents on a regular basis, and a lot of them are already investing with me and can't wait for us to find something that they can be part of. They're excited to do that. There are a lot of angel investors out there that are looking for great opportunities like this, so I hope to reach out to them. But first I need to find the right property. It needs to be the perfect fit, because if we start with the bad one, then we're going to hurt our reputation. So we need to start with a great one from the beginning and kick it off before we can take it nationwide. But that's the ultimate goal. That's the vision.
And back to the government, I want to just clarify. Have you tried to find tax abatement routes for properties? For example, you're going to have kids with autism, adults with autism. Is it going to help them to steer in this direction? Maybe not with the funding, but with some additional way to improve your cash flow?
Yeah, I mean, there are certainly things that the individuals who want to live there can apply for. There's certain housing vouchers and assistance they can get to help reduce their cost of living there, and we would be open to accepting any and all of those, including Social Security, all that kind of stuff. So we've looked at that. Tax abatement is usually tied to the affordability of the property and where it's located and what your rents are. So we'll have to assess that on a property by property basis because it's going to depend very much on where that property is located to see if that makes sense. So you just have to run the models, those spreadsheets that we love so much. We'll be plugging it all in there to see where it makes sense. But of course, if we can take advantage of tax abatement, we'll absolutely do that.
Yep. No, I think it's an important mission and you're on the right track. So are you actively raising funds for this nonprofit?
I don't raise for anything until I have it. Yeah. I mean, we'll take donations for what we're doing education-wise within the nonprofit. That's at valhallavillas.org if you'd like to make a donation to that. But we're not raising capital for the actual property until we have the property in place. And then that will be an investment, not a donation.
And you're going to create a fund for that particular investment?
Yes, we'll have a fund for that.
Love it. Awesome. Thank you so much for sharing. Okay, let's talk about your investor mindset and thinking forward about your legacy beyond this particular venture. You mentioned that real estate is not just about returns, but stability, stewardship, and impact. Can you speak to that mindset?
Well, I think when we have an abundant mindset, things just flow to you. So, I mean, when you want to give back and when you think beyond yourself, I could have kept doing this journey all by myself, but I was like, if I bring others in, they're going to make more money. A lot of people don't know how to vet a deal or don't have the time to do that, right? If I'm already doing that, why not share that with others? And then that comes back to me too, because now I'm making more on my money. And same with the autism housing. Once that gets really going, that can be the whole new model. I might not do any of the other stuff anymore, right? That'll probably be an all-encompassing thing. So here we can go do great things. Once again, we're still serving investors. Now we're also serving special needs parents and special needs individuals. We're serving the community. And it doesn't have to be something that's just something that you don't necessarily make money on. You can make money doing good things. And there's nothing wrong with that because then you have more money to go do even more good things. And I think that's a mindset that people don't often grasp. Like a lot of people look down on some of these billionaires and stuff, but if you look closely, a lot of them are doing some amazing things out there that they would never be able to do if they weren't making that money. So money is not the root of all evil. A lot of people have that mindset mentality. It's really the thing that can help you do wonderful things in this world if you choose to go that route. And so, that's a personal choice.
I think you will be able to make a bigger dent in this world if you have funds for that, right? And you can make a difference and enlighten lives of other people if you have the ability. And I think it's important. And what you mentioned, it just really struck me. We're not looking at those deals not only as a money generating events, but also you're creating specific communities that also will generate money, but also will serve specific need and will help people long term. And the communities and the country. I mean, the mission is great. I love it. Thank you so much for sharing. It's very important. Maria, I have last few questions for you today. So quick hits, lightning round. So whatever first comes to your mind, let us know. One book or resource that shaped your real estate mindset.
I'm trying to think of the author's name now. But it helps you create that vision, and it's what helped me lay out the vision for Valhalla Villas and for this whole process.
Just a vision or vivid vision?
Vivid vision, that's it.
Another book, yeah, that's what I remember that. That's a good one. Most important trait for a real estate developer, a business leader to develop?
Most important trait, transparency and honesty. Just be upfront with people. Tell them the good, the bad, the ugly.
Love it, because it's not about sprint, but it's a whole race, right? And building those relationships takes time, and it's easy to lose relationship and trust. It's the people will understand, and you will lose them forever. But if you always trustworthy and you're transparent, it will go a long way. Love it. One thing you wish you knew early on your journey.
That you could get into multifamily from the get-go. You could start that way. I had no idea. I mean, it was so far into real estate, I mean, decades in, that I realized that was an option. So I wish I would have done that earlier on. I can't imagine where I'd be right now if I had done that. So that's why I'm mentoring a group here in Central Florida for people wanting to do that right from the get-go. So through the Central Florida Real Estate Investor Association, we're doing a group for that.
Awesome. Love it. I have one last question for you. Where can people connect with you, learn more about Blue Vikings Capital, and maybe get involved with Valhalla Villas?
Yeah, so the place to start is bluevikingscapital.com. So that's my main website. It has connections to all my social media there. It has connections to valhallavillas.org on there. Has every way to get a hold of me, my email address, my phone number, everything. So bluevikingscapital.com. Let that be your starting ground.
Awesome. And we will leave that website in the description section if someone wants to get to know you. Maria, thank you so much. This is all from me. I had a lot of questions, I understand, but this, I think, was a very important, powerful message for our listeners. Thank you again for coming in today and sharing your story.
Thank you so much, Alex, for having me. It's awesome.
Thank you. And to our listeners, if you enjoyed this episode as I did, don't forget to like and subscribe and share with someone who needs to hear this.